Hey, it's Joel's coming at you with another variable rate update. So, next Bank of Canada meeting in December, of course, predicted rate increases 0.25%, with the idea that the freeze happens into 2023 where there's not much of anything happening. So that's right now where things stand. I wanted to take a moment. I like to do this between rate increases. Um, I still really have probably two things that I am nervous about when client calls. First of all, the vast majority of people call saying, hey, should we lock in? And although I realize that's the common kind of like knee-jerk question to ask, um, and I discuss that ad nauseum lots of my videos, but um, my bigger worry is that like the game has changed. And so like a lot of people are trying to use a lot of people are complaining about the game. Oh, interest rates are higher and those type of things. Not realizing the game's changed means we have to use different rules and look at different things. And so, what I really worry is, really two things: is that you can have the belief that interest rates are high for the short term, which means it's a momentary blip and you'll be fine, and the variable inevitably will be better. But the second thing that you could believe is that interest rates have now hit where they're going to be for some time, and that means that a fixed or variable rate will not avoid, like locking in will not avoid the inevitable, particularly right now. But had you had so many folks they go, oh, I should have had a fixed rate a year ago, but not realizing that inevitably you're gonna renew into a higher interest rate as it is. So um, first off, a couple kind of thoughts that are important. A, if you have a variable rate that's a static payment, means that you're like saying, or if you have a fixed rate for that matter, and your payment has not changed, you need to think about moving your payment up. I know that sounds like crazy, but like this is called hedging against inflation. Is that you need to really look at the idea that you move your payment up to where interest rates are, or else you're going to have one or two things. A, you're going to have a payment shock. It means your payment's going to jump very quickly, very fast when you come to renewal. Or secondly, you'll hit what's called the trigger rate, where you have to bring your amortization into line. Inevitably, fixed or if you have a payment, you will inevitably have to bring that payment in line at some point. So if you have a payment that has not changed, whether it's a fixed payment or a variable, get a hold of me. Let's talk about what we need to do on that. You don't have to do that, but I'm recommending that. Let's talk about the biggest thing here is that I'm going to circle back to fixed rates. Is that obviously the reason for rising interest rates from the Bank of Canada is to do with inflation. So let's talk about how a government does their budget. The budget just came out last week. So basically, there's a certain amount of revenue coming into the government. Revenue comes in from taxes, but also comes in from other things that they may incur revenue from. Sometimes they privatize things that are public. Air Canada used to be a government aircraft, so maybe they sell off the assets of that. There's other ways that they generate revenue as well, but mostly taxation. Okay, and so what happens is that when they do a budget and they don't have enough revenue coming in, just like a household budget, they are faced with three realities. First of all, if they don't have enough money coming in, how much they need to spend, they can cut costs. So cut social programs, cut things the governments are doing. Generally unpopular. Generally, people are not willing to experience that pain. Although it does happen, that is the first and, arguably can be one of the best ways to, in the long term, make a more stable financial environment in Canada. But people don't like that, so that's not the most favorable way of doing it. The second thing, obviously, if they can't cut costs from the budget, is to increase revenue. Now, that primarily means to increase taxes, whether that be income taxes or find other, like taxes that are new, such as, taxes that go on to, gas and carbon taxes and, all sorts of different taxes that they add. That's how they generate revenue. Tariffs from other countries, that's another way they generate revenue. Now, these only have a limit and they can be pretty unpopular. People don't like paying taxes. So we come to the third way. What happens if you, and obviously there's nowhere near the real numbers, what happens if you have a budget of $1 million, but you're going to spend 1.2 and you have a deficit of $200,000? A lot of people understand this being, oh, well, the government, overspends or they're in debt. Those are some partial truths to it. But the reality is that if they have a deficit on their budget, it means they have to increase the monetary supply. So it means they have to increase the money on and print more money. And so you hear money printing, and that takes forms in a lot of different ways. It can be the government selling bonds. So the government sells bonds to you. You make an interest rate. The government pays it back. There's a lot of different ways. Creating money through banks where they're offering some type of liquidity. That's a big way they do it. But what you need to understand is that, and this is the bottom line, the money is created out of thin air. It's as simple as it just being printed and as created. So yes, there's a lot of ways they do that, but that's what's happening. And so now we have more money supply into the country, and you could argue right now globally that's what a lot has happened. So increasing the money supply. The problem with that is when there's more money in the country, it's going to go to different things, and that money starts to you mean that more money can go to different assets, more money can go to different costs. It starts to expand the gap to inequality between wealth classes. All these things happen. Now, it might seem like the easiest way is to do it to print money, but all these things happen, okay? And so this is important to be aware of. Now, what's happening with the Bank of Canada is because one of the ways they print money is keeping interest rates low. What you found during COVID is two really big problems. Money being created without production. So when you're getting stimulus checks or you're getting checks just to stay home and you're not producing, so you're not going out and consuming goods or producing and taking a job, this becomes money that really is not moving. The velocity of money is not moving correctly. And so what happens with that is that, not what happens, but what has happened, and I think this has probably been something where the problem I don't think is really recognized, and I didn't recognize initially, but what we see a lot of is a lot of money sitting on the sidelines. So during COVID, I don't have enough things I can spend my money on, but I'm still making money, and I got stimulus money. So I take the $100,000, I put in savings, I put in GICs, I put in cryptocurrency, a lot of different ways that I essentially put that money on the sidelines. When I put that money on the sidelines, the money's not going into the things the government intended it to go into. And so increasing interest rates, in some way, the idea behind it is to take that money off the sidelines and put it into the economy. So that's the big deal here. When they think, okay, do they want you to feel, and it also creates a second thing where when you have a lot of savings, even if your income's going down, interest rates going up, you generally feel better, you feel wealthier. Well, the idea between interest rate increases is to make you feel more poor. And so you feel like you have less net worth, and you will decrease your spending in such a way. Now, I realize I just said that during COVID, that spending was really low, and that's one part of the problem. Here's the problem is that there isn't enough things going to enough things. And so, for example, if I go to the grocery store and there's 100 people wanting to buy a chicken, 100 people wanting to buy a chicken, and there's only 50 chickens. So this is people understand this as being people get this. So that means the price goes up because supply and demand. Very common economic thing that people understand. And so what if you actually can't get any more chickens? This is the problem. What if you can't get any more chickens? The common thing is get more chickens, supply and demand. But what if you can't get any more chickens and everybody needs chickens? This is the problem that happens in inflation. The actual answer to the problem is actually not to get chickens at all, but to start getting, beef and fish and all these different things, and create more and create more opportunities for consumption to happen, create more production, and that brings down inflation. Creates more production and brings down inflation. So inflation is brought down by there being more production. So watch the number of GDP, and so the more production, so the more things there is to consume, and the more ways there is for money to be spent and spread out across the economy, that will lower inflation. Now let's circle back around to interest rates, and this is where it gets a little tricky here. It's a little bit related, but a little bit unrelated as well. So the least profitable term for banks right now is going to be if you had a variable from a year ago, prime minus 1 or prime minus 1, 2. That's the least profitable term. Where I think people are misunderstanding is they think, as interest rates go up, banks make more. Not true. They make the same. And actually right now, they are saying, although I don't think it's as draconian as they make it out to be, that they are making less. But because it's the spread of money. And so they get goods or they get money at a higher cost, and because they get money at a higher cost, they lend it out at a higher cost. But the spread is actually thinner right now than it was. So they're with how mortgages work, their most least profitable product is going to be the variable that you had a year and a half ago. So if you feel the pressure from banks locking in, it's because, yes, that is the one they want people out of. But here's where this gets really tricky on the lock-in thing. You may think that, you know, a 1.9 fixed rate mortgage is going to be something that a bank wants to get rid of. It's not, because that actually is a better spread for them. They're making more money on that than they might be on the 5.5 because of how the yields work. And so, and that yield is actually changing, where it appears to be getting thinner all the time. And so where I bring this around and conclude this video with today is what we're going to see a lot of is that the profitability of a fixed rate, the profitability of a variable rate is already better right now than it was when a year and a half ago. But the profitability of a fixed rate is always better for a bank, but also is thinner than it was a little while ago. Because it's thinner than it was a little while ago, you're going to see really two trends. First of all, I cannot shout it from the rooftop enough. The comparison rate of when you pay your mortgage, which is your penalty interest rate differential, you're going to see those skyrocket, and people are not looking at that. The reason, above anything else, why we're not telling people to lock in, is that these comparison rates are going to be devastating. Let's say I bought a house last year for 5% down. CMHC fee means I probably put 1% down. You are underwater. You don't realize it right now, but you are underwater. If you need to sell your home, you need to take money out, no shot of taking it out. You are going to be underwater on it. So this is why we are avoiding those fixed rates, because those comparison rates are going to go up higher, because the yields are better on previous terms, and they don't want you paying out your fixed rates. They don't want you paying out fixed rates. They're going to lose money on that. So you think that when the bank gets a payout and they relend it, you think that means that they are making money hand over fist. But although it's probably not completely true what they say, they are not. And they want to lock you in that fixed rate. So watch for those comparison rates to skyrocket. Watch for you to get stuck on that stuff. That's very, very important. Very, very important. So anyway, if you want to discuss your mortgage, if you want to talk about variable rates, if you want to talk about anything going on, I am happy to discuss things with you. Please share this video with as many friends as you can. We would love to be assistance to them as well. Have a great week.